welcome to this special series, Get Started in the Market. While hardcore investors swear by the highs and lows of the stock markets, everyday people like you and me tend to stay away from the very idea of investing in these markets.
Stock markets for me is more like a risk and you have to follow it continuously. So I stay away from the stock markets for sure. Provident fund is the most preferred thing to invest in.
I do not invest in the stock market, and one of the reasons would probably be because I don't have enough of information regarding the stock market.
Absolutely not. I don't invest in stock markets or don't have a clue about them. Any the fixed deposits or NSCs, that's about it.
Most of these people you just heard told me that they would rather invest their savings in gold, real estate or fixed deposits. In fact, consider this.
Only about 3% of savings in India are actually invested in the stock markets. But why is it so? It is a fact that markets have been in a broad range for the last 6 years, reeling under the negative sentiment after the 2008 great financial crisis. Those who burnt their fingers in the last fall still remain wary, the investor confidence remains shaken and market participation extremely thin. But the signs of a changing tide are now emerging. The gloom seems to be lifting. Over the last few months, the stock markets have seen a big rally. Fueled by a historic election verdict, the market interest, it seems, is trickling back.
So are you part of this action in the stock markets, or is the fear of the unknown holding you back? Here on this show over the next 5 weeks, we will help you understand the stock markets, put it in perspective, tell you how to invest and where to invest, and also how to pick the winners. We'll help you get started in the market.
So let's start at the very beginning. What really is a stock? Simply put, a stock is a share in the ownership of a company. For example, if the company ownership is divided into 100 parts and you as an investor purchase one part or one share, then you will effectively own 1% of that company. Here is how the famous investor Warren Buffett defines a stock. See stocks as partial ownerships of businesses instead of stock tickers or pieces of paper which can be traded in the stock market.
Now that you know what a stock is, let's go ahead to the stock market or the stock exchange.
It is simply a marketplace where stocks are bought and sold. In older times, traders had to be present inside the exchange to buy and sell. But with today's technology, all transactions are done electronically and no one is required to be physically present at the stock exchange. There are two major indices in India, the Nifty and the Sensex. The Nifty is the main stock market index for the National Stock Exchange or the NSE. It consists of the 50 highest valued companies in India. And the Sensex is the market index for the Bombay Stock Exchange or the BSE, and it consists of 30 stocks. The majority of the trades in India happen through the NSE, and the Nifty today is an indicator to Indians and to foreigners as to how well or badly our economy is doing.
Stock exchange is a platform which allows buyers and sellers of shares to come together in a transparent and electronic way. It allows people to discover prices by continuously assessing the demand and supply and the valuation of the particular stocks, and that gives a fair price to the particular security, and then it helps in ensuring that each company is able to get the right valuation, and over a period of time it ensures that the capital is actually properly allocated to companies which are performing well or sectors which are performing well. Clearing and settlement function is an important function of the exchange. Settlement has to happen for all the trades which have been executed on the exchange. That is one more area where exchange plays a critical role. Over and above that, information provision is the critical function of the exchange. Exchanges provide a series of information about the companies which are listed on the exchange, which will be useful for investors to take informed decisions before they invest in any particular company. And another important area where stock exchanges play a critical role is the education, awareness and investor protection.
The other common phrases that you must have heard are bull market, like the one behind me, and the often dreaded bear market.
A bull market implies an upward movement in the indices when prices are expected to rise, whereas a bear market is just the opposite. It implies a downward movement and expectations of a fall in the stock prices.
So before you put your money into stocks, here's a checklist of what you need to keep in mind.
Firstly, what are your financial goals? This depends on your age and your money requirements at different stages of your life. Secondly, consider your asset allocation. That is, out of the total money that you want to invest, how much should you put into equity investments or the stock market, and how much in debt investments like insurance, fixed deposits, and then how much in other investments such as real estate, gold, and so on. This is called portfolio diversification, or in simple words, it ensures that you do not put all of your eggs into one basket. So even if one asset class does badly, your risk is spread out over other asset classes. To help you understand the importance of managing your portfolio and how to plan your asset allocation, it might be a good idea to consult a certified financial planner. Mr. Gaurav Mashruwala is one such expert.
Thank you so much, Gaurav, for joining us. My first question to you is, how important is it to take your financial goals into account before deciding how much to invest?
See, financial goals are like our destination. That's where we want to go. We need to know where we want to go, how we are going to go, when do we want to reach. Based on that, we do our entire planning. Similarly, when you're embarking on your journey of financial wealth accumulation, wealth creation, you need to know, because based on that, you will decide which asset classes, what kind of portfolio, what kind of diversification, what are the other hurdles that can come in life which can be tackled with the help of insurance. So it's like knowing where I want to go and when do I want to reach. So financial goals are of prime importance before embarking on any journey which you want to undertake.
Can you tell us what exactly does portfolio diversification mean and how does one go about that?
So basically, imagine a situation where in a cricket team you have all 10 batsmen, and then suddenly you realize, no, that's not the way. You need to bowl out the entire team, and then you again have all 11 bowlers, and you realize, no, that's the old way, we can't win. So we need to have a combination of some batsmen, some bowlers, wicket keeper. Similarly, your portfolio should consist of different asset classes. There are certain asset classes like equity, which are growth oriented, but they can be highly volatile. So when you have financial goals which are long term, which are going to occur after 7, 8, 9 years, you want to have certain amount of money in equity. There could be some near term financial goals which are likely to come up in next 2, 3 years. You want to have debt. Then to balance the portfolio, you want to have gold. So basically, diversification means making a team of players, similarly making a team of different asset classes, which is well balanced and based on your requirement. If you have everything in single asset, say equity, and if entire market falls, then your entire portfolio will go into negative.
Now, as far as equity investments are concerned, or investment into the stock markets, what should an investor really take care of, or what should he know before taking that first step into equities?
Only for long-term basis, enter into equity, because businesses take time to settle down. Apart from that, if you're going to invest into equity directly, then you should have the knowledge and the time. So you should have skills and the time both to understand that company, read balance sheet, know about the sector, know about the industry, the various announcements government has been making. So it has to be a comprehensive knowledge. Don't just jump into the equity and kind of get into a speculation mode, but do a thorough research, firstly of your own self, your portfolio, how to do it and where you are investing.
Gaurav, let's take an example. Assume an individual is earning, say, around 1 lakh rupees a month. Can you just explain how should he go about, breaking that up into different asset classes and diversifying the portfolio, and thereby how much is he left to invest into equities?
So first, decide on your financial goals. Once that is decided, you'll embark on your journey to create wealth to reach those financial goals. But while you are moving on, while you are embarking, while you are doing your journey, there could be hurdles that come in. For example, there could be income loss, either because the economic conditions are bad, or there is a job loss, or there is a catastrophe, and hence you need to keep certain amount of money for contingency. After that, the other hurdles that can come is there could be illness. It could be you to your family, so ensure there is enough health insurance. Then the next could be life insurance, death, because while you are traveling and while you are doing that, there could be a death, there could be a demise of an earning member of the family. Now if that happens, the surviving members not only will lose the income that is coming in, but there could be some other difficulties in the sense that future goals are also getting jeopardized. So
ensure there is enough life insurance. So we spoke about setting goals, contingency, health insurance, life insurance. After that, if there is any loans that you have taken, you may want to consider repaying that based on circumstances and the terms of the loan. Only after that, think of investments. Now, for near-term investments, goals which are likely to come in 2-3 years, look at debt as an investment, debt instruments, and for long-term, look at equity.
And finally, Gaurav, markets are booming. Everybody is slowly entering back into the markets and looking for ways to enter. What are golden rules that you would say for investors?
So when it comes to markets going up or down, people continuously keep looking at external conditions. Market going up is an external condition, economy improving is an external condition, stable government is an external condition. What you should look at first is your internal condition. When are my goals likely to occur? When do I require that money? I spoke earlier about contingency fund and insurance and loan. What are those things? So first look at those. If your internal conditions are secure, then obviously you want to enter the market, but then you decide whether you have skills and the time. So if you have skills and time to enter my market directly, do it. If you don't, then there could be other vehicles. One of them could be mutual funds. There are exchange traded funds which are kind of funds. So look at that. What will mean is, A, you will get diversification, B, you'll have a benefit of an expert kind of taking care of the decisions. So don't just jump into an equity market because there is this entire herd going and there's a lot of noise about that happening. Take a conscious decision. Equity has potential to generate good returns, beat inflation, but that is over a longer period of time. But be very careful. Don't just get into greed and rush to invest into a market.
But for all of us, the assurance about the safety of our investments tends to be the deciding factor of where we invest. But how do we know that the investments in the stock markets that we have made are actually safe and that there are no loopholes? That's where the Securities and Exchange Board of India, or SEBI, comes in.
The Securities and Exchange Board of India, or what we more commonly call SEBI, is the watchdog of the Indian stock markets. Now, SEBI's basic function is to protect the interests of investors like you and me in the stock market and to promote the development of and to regulate all matters connected to it.
SEBI Act says that SEBI has 3 prominent duties to perform. One is for development of the capital market, second is regulation of the capital market, and third is investor protection. Now, the question very often is asked, which one is the more important? The answer is all 3 are equally important, because without the one, other 2 are useless. Say for example, if you do not protect the investor, there is no role for development and what you regulate, because there is no need for protecting anything. The more emphasis lies in protection of investors, because they are the people who contribute to the risk capital in the market. One is through the regulation, other is through the inspection, third is the penalty mechanism, and then keep on issuing the guidance from time to time, and advisory also, and complaint redressal mechanism. So there are various multiple ways that SEBI tries to protect the investors.
So now maybe you've started to think about investing in the stock markets. But how will you legally own part of one of the best companies in India? We'll tell you on the other side of this break. Welcome back. You're watching Get Started in the Market. So you're all ready to invest in the stock markets.
But what do you really need to start buying stocks? A broker, the person who will buy and sell stocks on your behalf. A trading account, an account through which your transactions will take place. And a demat account where the shares that you own will be stored in an electronic form.
So let's go through each of these one by one. Firstly, a stockbroker. A broker is the one who will be your bridge. He will buy and sell shares on your behalf. But how do we choose a stockbroker?
So here's a checklist of what you need to tick while zeroing in on your broker. First and foremost, make sure that he's registered with SEBI. Do a thorough background check. How long has he been in the business? Ensure that he has a clean track record. Your broker should be authorized to offer all the products that you want to invest in. Get an absolutely clear picture of the transaction costs and fees that your broker will be charging you. Ensure that there are no hidden costs.
Once you have your trusted broker, he will ask you for your demat account and your trading account details. Just like you need a bank for savings and other financial transactions, you need a demat account and a trading account to hold, sell and buy shares.
A demat account is where your shares are stored in an electronic form, which means that you do not need to manage any physical paper certificates. And a trading account is an interface between your bank account and your demat account for buying and selling shares. So simply, if you want to buy 100 shares of a company which are trading at 50 rupees a share, you will have to transfer 5,000 rupees from your bank account to the trading account, and once your broker buys these shares for you, they will reflect in your demat account. Here are some points that can help you understand better and break a few myths. It is not necessary for you to have a demat account with your broker. You can have more than one demat and trading account. While there are many brokers who also provide demat services, their functions are different. A broker buys and sells shares on your behalf through the trading account, and those shares are held in your demat account.
Most financial institutions, or depository participants as they are known, offer you the choice of having your demat account opened with them.
And if you want a one-stop link to know which DPs are offering these services, simply visit these websites: www.nsdl.co.in and www.cdslindia.com.
Many of the bigger financial institutions integrate all your three accounts, that is your bank account, your trading account as well as your demat account. Mr. Sanghvi has decided to open a demat account with Motilal Oswal Securities Limited. Let's get this process started with him.
Hi sir. Hi. A very good morning. Good morning. How are you doing? Fine. How are you? Please. So this is our form. Okay. And normally like initially you have to fill up a KYC form, which is basically is know your client. Okay.
The main objective of KYC, or Know Your Client, is that it helps govern your relationship with your broker and ensures that your account is not misused. SEBI has made this process mandatory.
This is a simple form we are filling with his basic account details. One thing to remember that's very important is keep your permanent account number or your PAN card handy. It is very important to have this for both your demat and your KYC.
These are the documents required, the PAN ID and the address proof. Oh, perfectly fine, sir. So would you like to have any nominee, because it is mandatory as per SEBI? Yes, I would like to nominate my daughter, Ms. Prisha Sanghvi, as a nominee. Okay, perfectly fine, sir. Do I need to pay some fees to open the account? Yes, sir. There is a like yearly maintenance fees, which I can show you. It's over here. There are various slabs. You can opt any of one of these. Okay. And do I need to have some balance in my account or some pre-owned stocks? Not at all, sir. Is it fine? Perfectly fine, sir. Thank you, sir. Once it will be processed, you'll get your DP ID and account statement on your mail as well as a hard copy on your address. Fine. Thank you. Thank you very much, sir. Nice meeting you, sir. Same here.
And now, with a trusted broker, a trading account and a demat account, Mr. Sharma is ready to part own some of the best companies in India.
These screens you can see here show the names of several public listed companies in India. The National Stock Exchange has more than 1,600 companies listed on it. This simply means that you can now own any one of these companies with the tools that you have. But remember, always invest wisely and do your homework well in the companies that you want to invest in.
You must treat your wealth as carefully as you treat your health. You must always remember that there are no quick wins, and if in the long term one has to have financial prosperity, that is not a T10 or a T20, you know. It's based on fundamental rules, and one has to understand the risks one takes, and returns go only with the risks that you take. So I would advise that one should have a diversified set of investments to look at in the first place. One should be very conscious of what risks one can take and then take the first step of putting money into risky assets.
Hope we've helped you understand the basics of the stock markets along with the confidence of being protected by both the exchanges and by SEBI. But that's not where we leave it for you. This was just the startup kit. Join us next week as we tell you what happens behind the scenes at the exchanges to actually enable your trade. Till then, get started in the market.